Are you excited to invest in real estate? Excited to get calls about noise violations from your tenants' neighbors? Or what about having to deal with flooding damage in the bathrooms? Or maybe you're excited to get to meet and interview 20 applicants to fill a vacancy. Ah, the joys. Or are you excited to invest in real estate where you never get calls from tenants, where you spend only a few minutes every month reviewing your investment? Or how about getting bigger returns than you expected? That's my kind of real estate investing, and I'm guessing it's probably your preferred scenario as well. I'm Susan Elliott with Flow State Investing, and in this video, I'm going to teach you 5 reasons you should ditch the rentals and invest in real estate-backed notes. A little-known strategy in the real estate investing world. If you're new here, don't forget to hit that like button and subscribe so you can see more of this content. It also helps others discover it as well. And as always, stick with me to the end to catch your moment of flow. Ready? Let's jump in. We know real estate investing is a powerful wealth-building vehicle. I mean, if 90% of the world's millionaires get there because of real estate, it's pretty fair to make that claim. But they didn't get there by managing 1 million rental properties. And I'm going to tell you 5 reasons that you should think about getting your money working in note investing instead of in rental houses. First, if you haven't heard about note investing, check out my video about how it works. The link is in the description below. For a quick overview, the note is the paper behind every real estate transaction and can be a cash-flowing asset. The note consists of the loan documents, the terms, interest rate, down payment, and the mortgage or deed of trust that secures the physical house to those loan documents as collateral. We can buy the note and either cash flow from the interest payments, like a bank does, or we can add value and flip the note. Again, I dive deeper into how it works in our other videos and our video about the value add strategy of note investing specifically. All right, reason number 1 to ditch the rentals is your time. This is the big one because your time is the most valuable asset. They aren't making more of it, so you better spend it wisely. Investing in notes requires very little of your time, whether you are partnering with an experienced team to flip notes or you hold a performing note yourself. A note partnership, like those we do here at Flow State Investing, allows you to access the steeper discounts and higher returns found when flipping non-performing notes into performing ones, without spending your time doing all the legwork required to mitigate risk. Okay, reason number 2 is that you have owners instead of tenants. The owners of the home are paying you instead of tenants, and most owners have a much higher stake in making those payments than a tenant does. With every payment made, owners build up their equity, giving more and more reason to make the next payment. They also typically take way better care of the property. Since that house is your collateral or the security on your investment, this actually matters. Okay, the third reason to invest in notes instead of rentals is that no one calls their lender when a pipe bursts. As a note investor, you never deal with any maintenance issues, no contractors, no yard work, no snow removal, and you aren't leaving that work to tenants either. Remember reason number 2? The owners take care of their property, not you. Reason number 4 is the magic of amortization. If you have taken a closer look at that amortization schedule on your mortgage, you know what I'm talking about here. Notice those first few years of payments are mostly interest. That means that as a note investor or the lender, you get to collect more of your returns early on to mitigate risk. This is a huge form of risk mitigation. And since our homeowners tend to either sell or refinance before year 7 of homeownership, you get a full payout after having made a huge chunk of your return already. In fact, your yield increases the sooner the borrower pays off their debt in full. Think about it. The banks don't own rental properties. They own the notes. And let's just say that the banks know how to make money. My guess. Okay, and finally, reason number 5 to ditching the rentals and investing in notes is that your investment can make a huge impact in helping a family create generational wealth, especially when investing in non-performing notes. True, giving a quality home to a tenant may help them build a better life, but helping someone build equity and their own home, that is the pivotal point in creating a foundation for financial stability and wealth preservation for not just them, but also for subsequent generations. Okay, let's review. The 5 reasons to get your money working in notes instead of rental properties are: you will spend less of your time. 2, you have owners instead of tenants. 3, no one calls the bank when a pipe bursts. 4, the magic of amortization. And finally, 5, the multi-generational impact of helping homeowners keep their home. We love note investing, as you can probably tell, and would love to chat with you to see if a note partnership may fit into your investing strategy and life goals. Join our investor circle to schedule a call with me. The link is in the description below. Also, don't forget to like this video and subscribe to our channel if you found value here, or share this with someone who you know wants to stop trading their time for money and maybe stop being a landlord. I'm Susan Elliott with Flow State Investing. Now, here is your moment of flow. Have an awesome day.